Fun fact, did you know that online retail is in decline? No? Not many people did. Well, hello, and thank you for joining me today. In today's session, we are going to give you a briefing on a couple of things that have been happening in the world this week. So, without further ado, let's talk you through our slow money briefing. Hello and welcome to the briefing. The Chancellor Rishi Sunak has announced the government support scheme. The economy faces a hit of £250 million a day from the partial lockdown measures. And companies have begun to reverse some of the return to work schemes that we had witnessed across the autumn. COVID continues to accelerate a lot of the existing trends, polarising how this is affecting business. And the UK housing market defies the pandemic, with average house prices hitting a record high. This is in contrast to the wider economy, of course. The Bank of England have been talking a lot about negative interest rates. Find out what they've had to say and if it's really a possibility. Want to find out more? You can always go to slowmoneyclub.com.
It's now a good time to invest in the stock market. With most global markets having recovered most of their post-pandemic losses, which sectors will recover and which ones will benefit in the new economy? Is investing in commercial real estate still an option given how much it has fallen since the start of the pandemic? Is now a good time to go into buy-to-let? Or is now a good time to buy your own home for the first time? Especially with the whole new work-from-home culture that is expected to be the norm. Either way, is it better to get into new builds or to buy existing stock? Well, get the tools, knowledge and mindset coaching that you need to build wealth by buying passive income assets that will help you get rich slowly. Join the Slow Money Investment Club.
So thank you for joining me. And those are the key talking points that I want to cover this morning. And I think we'll start with the government's job retention program. So the government plans to directly support up to 60% of wages for people in viable jobs. The question is, what is a viable job? So significantly less generous than the furlough scheme that it's replacing, but it's also significantly less expensive than the furlough scheme it's replacing. To cost this, the government have said that they expect to pay about 1.2 billion for the new scheme, whereas for the existing furlough scheme so far they've spent about 40 billion, and that's not over yet. The new scheme is expected to start in November and will run for 6 months. Some say it's only kicking the can down the road for 6 months. Separately, the government also announced a pay-as-you-grow scheme. The scheme will allow companies more time to repay bounce-back loans over a period of 10 years instead of the original 6. The scheme aims to help companies with more time to pay back their loans. So the payback period for bounce-back loans and CBILS has been extended from 6 to 10 years. Those struggling to pay them back will now be able to make interest-only repayments as opposed to capital plus interest, and anyone in real trouble will be able to suspend the payments altogether. This will be good for any businesses who took out the loan, but what does it really mean in the context of viable jobs? The Chancellor made this, quote, viable job statement in his talk to Parliament. But the question I have really is that who gets to decide what jobs are viable and what jobs are not? So much has changed in the last 6 months since the pandemic started that, companies that were viable 12 months ago may not appear viable right now. But market forces could change when a new vaccine is introduced, for example, and bring those companies back into play. I'm thinking of the travel industry, the leisure industry, and places that have been shut down in large part because of government measures, but now could be deemed as non-viable through no fault of their own. But then once a pandemic eases or a vaccine is created, they become viable again. What happens if those lost jobs have already been lost, if people have already had to change careers, etc. Of course, zombie companies, that is those propped up purely by cheap money, are bad for productivity. And we saw this since the financial crisis. There have been a lot of zombie companies around, and they've been effectively getting high on their own supply, or on the government supply of quantitative easing, amongst other things. What is the cost of this second phase of lockdown we are about to enter into? Well, the new COVID restrictions come into force, and the economy faces a hit of up to £250 million a day if these new partial lockdown measures reverse some of the trends that we'd seen with things like people going to pubs and restaurants and returning to work. According to the Centre for Economic Business and Research, GDP could fall by as much as 3 and 5% in the fourth quarter alone if we begin to reverse some of the trends we'd started to see. London alone could face a cost of $2 billion as a result of these partial lockdown measures. And as we've seen, a lot of the city companies have begun to reverse the return to work programs that they began in the autumn when schools started reopening. So what's the government's plan? Well, it seems that the UK government has a plan to reduce contact more than anything. So the virus obviously spreads through contact, yet businesses need a certain number of people in order to remain viable. So it seems that what the UK government is doing is managing this, and through that lens, things like the 10 p.m. curfew and the rule of 6 make a bit more sense, whereby businesses need probably about 6 people in any sitting or can cope with, and that increases the viability. Below that, and it starts to become a cost. Likewise, we know that in the evening, most people who go to pubs will have become a bit inebriated. We know the virus is spreading in places like pub because of loud talking and spittles that come out of people's mouth. So while not shutting pubs won't stop the virus spreading, reducing the evening period when people may be a bit more lucid and reducing the access and the availability of that contact is basically what the government's plan is, at the same time allowing pubs to remain open so that the economic benefit is mitigated. And I think through that lens, I see that the government is focusing on reducing contact more than anything. And this post-pandemic world, we still continue to see a lot of trends accelerated. So COVID is accelerating a lot of trends that we had seen prior to COVID, and this is having a polarising effect. The virus has fundamentally changed a lot of industries. New strategies are needed in order to deal with this post-COVID era that we're living in. In the retail sector, for example, we have this thing known as the unremarkable retail in the middle, which is clearly struggling post-pandemic. A lot of local, smaller shops have reopened, able to socially distance and able to carry on working. A lot of the bigger shops and retailers able to carry on, move a lot of their things to online, and the stuff that isn't online they're still able to manufacture and produce. But the unremarkable retail in the middle is really struggling. Likewise, we've seen hotels struggling because of lockdown measures. We've seen the hospitality and leisure sector, entertainment sector, arts sector all been pretty much diminished by lockdown measures. So it's been quite an interesting time, I think, for these businesses. If you think about commercial property, for example, return to work has been paused by most companies, and about 73% of companies believe that COVID will result in them downsizing their office space en masse. So that's really a big number. But at the same time, only 37 of them have actively planned to do so at this point. What this tells me is that there is going to be a gradual shift. So while nobody is working in the office, companies are going to shift gradually in terms of reducing their office capacity. I think this will be helped by more equitable new arrangements between owners and occupiers for leasing retail and office space. This could include things like turnover rent, where the rent is based on a percentage of the revenue generated in the premises as opposed to just being a flat rate irrespective of the footfall or the revenue. So I think the relationship between landlords and tenants will change. arrangements between them will mean that the transition will be a lot more drawn out than many people are predicting at the moment. The UK housing market continues to defy the pandemic. Average house prices have been hitting records. Figures from Nationwide show that figures from Nationwide Building Society show that house prices are rising at an all-time high. The fastest, in fact, they've risen for almost 16 years. This is somewhat at odds with the wider economic turmoil that the UK is facing, and we're still in the very early stages of any seeming recovery. Plus, we are about to hit this second wave. So what's behind this apparent contradiction between house prices and the broader economy? Well, there are four main reasons that is driving the accelerated house prices. And in this drill down, I wanted to go through those four reasons. So number one, an obvious one, is pent-up demand. During lockdown, 150,000 house purchases that would have otherwise taken place had to be put on hold between March and July. While there would have been some extent of pent-up supply to match this, while there would have been some extent of pent-up supply, data from RICS suggests that buyers have returned to the market in much bigger numbers than sellers. So you have much more demand than you have supply, which is boosting prices and accelerating the growth there. So pent-up demand has been a big factor, but another big factor supporting that has been the government support measures. So companies so far have borrowed about 58 billion in emergency loans backed by the government. This is C-bills and bounce-back loans. That's according to the Treasury. On top of that, the job retention scheme has been instrumental in supporting jobs and wages and therefore demand. As people have been at home not working, they're still getting paid and are able to do things like go on Zoopla and find new properties. About 40 billion has been used to cover the wages of furloughed workers so far. Alongside those two measures, you have about 13.4 billion has been used to help self-employed workers. So the total for the variety of schemes from the government is over 100 billion. This is direct money pumped into people's hands, companies' bank accounts. And these individuals and companies now have a lot of short-term liquidity. And these government measures have indeed created a lot of short-term liquidity in the market. A lot of that liquidity has found its way into asset prices, whether that's stocks and shares, but definitely property as well. So you have the pent-up demand, and then you have the government schemes and support measures. We also know that there's a differential impact of lockdown on incomes. What this means is that lockdown and the pandemic has disproportionately affected people on low incomes. Low-income workers, particularly those in the gig economy, have had their incomes slashed either because they can't work or their hours have been vastly reduced. And this, so far, has not affected people on higher incomes and people on non-gig economy type jobs. People who are able to work from home without having to sacrifice their pay. What this means is, as a result, the housing activity over the summer has been disproportionately skewed towards people on higher incomes and therefore higher value properties, which is pushing up the average house price. So people who are on lower incomes are less likely to be buying property in this type of conditions, but actually the people on higher incomes are more likely to be buying property in these conditions, and that's creating a skew in the average price. The last and probably the most obvious reason is the July stamp duty cut. So in July, the Chancellor cut stamp duty, and it's estimated that this will increase the price by about 1.2%. So the stamp duty alone will drive up prices by about 1.2%, but it also lead to about a 6% increase in the volume of transactions. This is compared to what would have happened if there was no stamp duty cut. So in summary, we have four main reasons: the pent-up demand that comes from people not being able to buy through March and June, the government measures that they've announced, which have pumped about over 100 billion in liquidity into the market, the disproportionate impact of lockdown and the virus on people on low incomes means they're less likely to be in the market for property now, whereas people on higher incomes are more likely to be in the market for property now. And finally, the stamp duty cut that the government announced in July. So all of these things have really been sort of like a rocket booster in the property world. And finally, so for the first time, the Bank of England is seriously considering the unprecedented step of sub-zero interest rates. Some considered this to be forward guidance when the bank spoke about it in their Monetary Policy Committee meeting minutes, but Andrew Bailey has subsequently made clear that the bank are not about to push interest rates below zero in the near future. It just wanted to be sure that if it did do that any time in the near future, the commercial banks and the other participants in the system would be able to implement the policy and transmit the rate without the whole system blowing up. So we're not about to see negative interest rates soon, but it's still something that they're considering. They're looking at the technicalities of how that will work. In the next episode, we'll talk a little bit more about negative interest rates in terms of what they are, what that means, and the fact that you can put money in the bank and pay to keep your money in a current account is a bit obtuse. So we'll go into it in a bit more detail in the next episode. But before I let you go, I want to share with you a little message from our sponsors.
It's now a good time to invest in the stock market. With most global markets having recovered most of their post-pandemic losses, which sectors will recover and which ones will benefit in the new economy? Is investing in commercial real estate still an option given how much it has fallen since the start of the pandemic? Is now a good time to go into buy-to-let? Or is now a good time to buy your own home for the first time? Especially with the whole new work-from-home culture that is expected to be the norm. Either way, is it better to get into new builds or to buy existing stock? Well, get the tools, knowledge and mindset coaching that you need to build wealth by buying passive income assets that will help you get rich slowly. Join the Slow Money Investment Club.
And to do that, all you have to do is go to slowmoneyclub.com and join the club. So, before I let you go, fun fact. Did you know that online retail is in decline? No? Not many people did. Well, in August, online retail had their biggest monthly fall since 2015. So sales fell 2.5% compared with July. What does this mean? Well, I think a lot of the commentary that we've been seeing is around how everything is moving online and online. But actually, July to August, online sales fell. This was driven by many things, but as we saw at the start, there was a substitution from physical to online in March. And then that continued across the spring and the early summer. What happened is once we reopened, there was competition. But in July, online sales were still strong. August, we had the government's scheme, Eat Out, Help Out, and we saw a lot of substitution from online to restaurants, which is quite interesting because what that means is that people were not buying as much online and were leaving their house more. But what is interesting is that if you look at the sales in August versus February pre-lockdown, August is actually 4% up on February. So the key thing is that even though month-to-month sales were down, online sales remain at a high level in August, even though shops have reopened. And I think that indicates the trend that this is here to stay. So even when everything is fully open, we're probably going to see a long-term trend of online sales being higher now than physical sales. If we look back, maybe even I think it's 4 or 5 years ago, online sales only represented about 20% of total sales. And in 6 months, that's totally shifted. I don't think it'll be reversed. I think we'll have more substitution, but it's not going to reverse. And even though things opened over the summer, we had substitution over the summer, we have discounts and unlocking over the summer, online sales were still 4% up versus February. So I think that's really key in terms of trend analysis and shows you that this trend or these trends that we've been observing and the things that we've been seeing so far are here to stay. So we hope you've enjoyed this briefing. Join us next time. If you'd like to find out more, make sure you go to slowmoneyclub.com and join the club, and we'll see you soon.
We hope you enjoyed this episode. If you'd like more information on what you just heard, go to slowmoneyclub.com and join the club. Don't forget to subscribe on Apple Podcasts, Spotify, or whichever app you use. And please also give us a 5-star review. That way you get the latest episode on your phone as soon as it's released. You also help other people discover this podcast